We've seen a risk-off sentiment in the markets this morning because of the China virus. We had, treasuries and the yen up, the yuan at the lowest since September. I mean, could this potentially be the reason why markets sell off? Given the euphoria.
Yeah, well, one has to look back over the past 12 to 18 months, really. And the market has been very resilient. And in fact, given where conditions are today, it's difficult to see one particular event to really trigger, or at least to prognostic on the ability of an event to trigger risk-off sentiment in a scale that we would see as a massive correction. Right now, we don't expect that. We think the risk-reward trade-off is probably skewed to the downside. But given where we are in terms of monetary conditions, the visibility we have, growth may be slower, but it's still growth, and it's right now, most regions or major economies are forecasting growth for 2020, which is a tad slower than growth for 2019. But we're not looking at a recession anytime soon. Anyway, that's what we think. And geopolitics has been mainly the trigger event that could be seen as the one that could shake off sentiment. And we've had many geopolitical considerations over the past several months, and the market has shrugged them off.
But if you take a look at our experience with SARS, I mean, that really impacted markets globally. What would it take for markets to rethink the strategy in Asia and the investments in the region?
Well, if I knew that, I think right now, one particular small event, or smaller, one event that is isolated does not seem as to have the potential to derail the markets. From my perspective, I think what could derail the markets is a radical change in monetary policy, be it on the back of inflation or an external event that could trigger disruptions. Right now, we've been talking about, the China-U.S. trade deal phase one as appeasement in the trade environment. Well, maybe this is just a pause. There'll be other, I think, discussions. Maybe there'll be other mini trade deals, but I think it's only one way. Right now, the trend is only one way, and I think that could also, over time, affect global growth and therefore market sentiment. But right now, in 2020, given the environment and the visibility we have, we don't see any specific cause that could trigger massive corrections. That could happen. The risk is skewed to the downside given where valuations are, and they're elevated. They're a bit somewhat less elevated in Europe and in emerging markets and in Asia than they are in the United States, but nonetheless, they're not completely out of sync with the underlying economic fundamentals.
I want to touch on your business, which has a very unique model, a network of autonomous boutiques. I mean, one of your affiliates, H2O, recently saw a rush of withdrawals because of bonds, which were difficult to trade and linked to one German financier. Since that incident, are you looking at tightening risk controls? What are you looking at doing?
Well, we've announced some measures that could enhance our risk controls, both at the level of the group as a whole and within the affiliates. That being said, if I want to go back to H2O for a second, one has to say that the promise of liquidity was kept despite the massive outflows. Since then, there's been flows that have been coming back to H2O, and performance has been good. I would also observe that, as you said, our model is somewhat unique, or at least very differentiated, and what has happened at H2O did not have any impact on the rest of our business. And since then, of course, business has been very good.
But should H2O have been allowed to make those investments?
Well, this is part of the framework of the UCITS in Europe, where the regulator is allowing UCITS to have a pocket of investments in non-liquid assets, non-listed assets, I should say, non-listed assets. And perhaps that's because the regulator feels that money should go into private situations where there can be a development of the economy.
You're doing an audit on H2O. What's been found so far?
Well, I'm not going to comment on that. The audit is still working its way through.
When do you expect the audit to be completed?
Shortly.
Sometime in the next few months?
But this is not something we make public. This is something that is really for internal purposes. But as you mentioned, we announced earlier, as I mentioned, in November, measures that are designed to address some of the lessons learned from that episode.
This autonomous model, does it make it easier for you to make acquisitions?
Well, it's clear that investment teams that hit a glass ceiling at some point, be they that they have 2 billion of assets under management or 20 billion of assets under management, very much see the benefits of our model where they retain their entrepreneurial spirit, where they retain their brand, where they're able to be entrepreneurial in many respects, yet have the benefit of scale through our centralized distribution, through our provision of seed money and sponsor money to launch new products, to our ability to support them in terms of communications, HR, or even M&A to bring other teams on. So our model is very attractive. Lots of people are knocking on our door. But we're selective. We have the ability to be selective, to really bring into the group affiliates to which we can bring something and which brings something to the group. We're not private equity in asset management.
So fair to say you're looking at acquisitions?
As always, we have...
Where? What assets?
We've made acquisitions recently, brought into the fold, either through outright acquisitions or to seed of new money, seed of new teams, areas where we felt we could be more present. And that's private debt with MB Credit a year and a half ago. That's IML in Australia 2 years ago. That's seeding Natixis Asset Management, which really brought into the group a thematic expertise very much in tune with the sustainability discussions that are permeating this gathering this week. And so we want to expand on areas where we have shortcomings or in areas which are very key for our clients, and notably in the private asset space, given where yields are and given the visibility we have on the fact that yields are likely to remain low for long.